No one likes paying taxes, and everyone thinks they pay too much. If you agree with that sentiment, you're probably right. But what if I could show you how you're potentially losing thousands of dollars to taxes simply because of what you don't know? Hi, I'm Keith Demetriades. Today we're discussing traditional IRAs and Roth IRAs, their role in retirement strategies, and how the choice you make can affect the amount of taxes you pay. Death and taxes are two of life's certainties. You can't avoid taxes altogether, but you do have a choice of when you pay them. Understanding the difference between traditional and Roth IRAs and what those differences mean for your tax bill lets you make decisions that can reduce the total amount of taxes you pay. Here's the first thing to be aware of. You pay your taxes at different times depending on the account type. With a traditional IRA, you contribute pre-tax dollars, which means you get a tax break up front. But you pay taxes when you withdraw the money in retirement. On the other hand, a Roth IRA is funded with after-tax dollars. So you pay taxes today, but your withdrawals in retirement are completely tax-free. Roths can be valuable because you don't have to take required minimum distributions or RMDs during your lifetime, allowing your money to keep growing tax-free. There's also the potential for double tax savings if you live in a state without any sales tax. These benefits are major and shouldn't be overlooked. But let's not forget about the one big drawback. With the Roth IRA, you pay taxes up front. Less money goes directly into your account, so you have less money working for you. This is a big deal. It doesn't make a Roth IRA a no-go, but I want to underscore this idea because less principal can translate to less earning power over the account's lifetime. You'll also want to be aware that Roth IRAs have what's called the 5-year rule. This means that if you want to withdraw earnings tax-free, your Roth IRA must have been open for at least 5 years, regardless of your age. Traditional IRAs, on the other hand, allow you to contribute pre-tax dollars, which gives you an immediate tax break. This upfront tax advantage means you have more money going to work for you right away, which might boost the growth potential of your investments over time. Traditional IRAs might also help reduce your taxable income in high earning years, which can be a big benefit if you're in a higher tax bracket. They do come with some important drawbacks though. One key limitation is that you must start taking required minimum distributions, or RMDs, once you reach 73 years old. It's not optional. That means the money in your account can't continue to grow tax deferred indefinitely. Those required RMDs also mean traditional IRAs don't offer the same flexibility when passing wealth to your heirs. Since you're pulling money out every year, the remaining balance might be lower when you pass than it could have been with a Roth. One last thing to note here is that when you withdraw funds in retirement, they'll be taxed at ordinary income, which could push you into a higher tax bracket. These things don't make a traditional IRA a bad choice, but just like with the Roth, you'll want to weigh the pros and cons when planning your long-term strategy. Understanding the tax treatment of traditional and Roth IRAs also helps provide a reference point for how similar investment accounts are taxed. For instance, the traditional IRA, traditional 401k, the simple, the SEP, they're all tax deferred and they're taxed similarly. And the Roth IRA, the Roth 401ks, HSAs, they're all tax free. Recognizing these categories help you make more strategic decisions about contributions and withdrawals, and even your long-term tax plan. The last piece of the puzzle is understanding U.S. tax rates. The federal income tax rates are progressive. As taxable income increases, it is taxed at higher rates, but each tax rate only applies to income in that specific tax bracket. This can be confusing because many people think their entire income is taxed at that same rate, but that's just not the case. For example, if a married couple filing jointly has an income of $203,051, only $2,000 of that income falls into the 24% tax bracket. That is all that will be taxed at the 24% rate, not the entire amount. That's important to understand. Look, none of us has a crystal ball, but when we consider taxes, most people presume, probably accurately, that taxes will go up in the future. Plus, after 2025, this year, the Trump-era tax breaks are scheduled to expire. That will likely cause marginal tax brackets to increase by 2 to 3%. While these are pretty fair assumptions, let's combine all the pieces to get a more accurate picture. The goal is to make informed decisions based on what is most probable for you, not what is possible for you. When considering traditional or Roth IRAs, there are 4 basic rules. That's it. Keep it simple. Rule 1. If your personal tax bracket will most likely drop over time, typically the 24, 32, 35, or 37% tax bracket currently, then choose the traditional IRA. Let's say you're 55 years old, you're making $450,000 a year. This puts you well into the 32% tax bracket if you're married filing jointly. Assuming you'll retire in 10 years and they live on approximately $100,000 per year from all their income sources, you'll just barely be into a tax bracket of 22%. Now, I don't know about you, but I'd rather pay my taxes later when I'm in a lower personal tax bracket. That's why the traditional makes a lot of sense here. Rule number 2, if your personal tax bracket will most likely increase over time. So your current situation has you in a 10, 12, or 22% personal tax bracket. Then choose the Roth IRA. Now, if you're a younger investor starting your career with a relatively lower income, the Roth is a better choice. In this scenario, paying your taxes now at the lower personal tax rate is better. Later, when your income is increased, putting you in a higher tax bracket, you can take those earnings out tax-free. That's a good deal. Rule 3, pick based on what feels the best to you. Let's say you're caught in that middle ground, those middle personal tax brackets of 22 or 24% for your current situation, and the future looks about the same. Or maybe you would just feel better having tax-deferred or tax-free dollars. In this case, pick the path you feel most comfortable with because it probably won't make a huge difference. Remember, most of our financial decisions are emotionally charged. There is the math or logic to the decision, and then there are the feelings and the emotions involved. If it's a close call in the math, understand and manage your emotions so that you're fully satisfied with your decision. And the final rule, number 4, choose to have both kinds of accounts, the Roth and the traditional IRA. Put them both in your lineup. Having both types of accounts, traditional and Roth, gives you the flexibility in the future to choose where to withdraw funds from in retirement based on your income situation at that time. These strategic choices will help in managing your taxable income and making tax-efficient decisions. Let's say your income from Social Security, pensions, and a traditional IRA puts you in the upper portion of the 12% tax bracket. Now, let's say you need to generate more income for some reason. It would be great to have the choice to withdraw money tax-free from a Roth and or maybe a taxable account where you're also harvesting losses. Or let's say another scenario, your income is in the lower portion of the 12% personal tax bracket. Maybe withdrawing from your traditional IRA would make more sense than taking money from a taxable account where you'd pay 15%. The point is that if you follow Rule 4, you have options. Who doesn't like options? Options are always good. If all your money were in Roth or HSAs, which are tax-free, you might be paying too much in taxes while you're generating a sizable income. And if all your money were in traditional IRA, then you'd be missing out on the tax-free advantage. Diversifying means you can reap the benefits of both types of accounts. Keeping Rule 4 in mind, let's imagine you have hardly any invested money in Roth IRAs or tax-free money, and you've decided you'd like to diversify your investment types so that you can make strategic choices later. Great idea. Roth IRAs offer a unique opportunity to diversify tax strategies. You can convert some of your traditional tax-deferred dollars to a Roth. Now, you might have heard about Roth conversions and wondered if they were worth considering, especially once you've retired. So let's talk about that. Basically, a Roth conversion involves moving money from a traditional IRA or a 401k into a Roth IRA. It can be an attractive option because the future growth and withdrawals from the Roth IRA will be tax-free. But the catch is that you'll have to pay taxes on the converted amount today. So the decision to convert isn't one you should take lightly. You'll want to consider your current tax situation, your expected future income, and whether you have the cash available to pay the taxes without dipping into your retirement savings. Something else to consider about a Roth conversion is that timing is critical. Converting during years when your income is lower, such as early retirement years before Social Security or pension payments begin, can potentially reap some great benefits while minimizing the tax impact associated with the conversion. Here's an example that demonstrates why timing can be so important. Imagine you're 62, recently retired, and plan to delay taking Social Security benefits until age 70 in order to maximize your monthly payments. During this gap between retirement and claiming Social Security, your taxable income might be lower than it will be later in retirement when Social Security and other income sources kick in. This period creates a unique opportunity to perform a one-time larger Roth conversion with a lower tax cost. This kind of conversion can be beneficial if you think your income might increase significantly later in retirement due to Social Security, RMDs from other accounts, or other income-generating resources. By acting during this income valley, you minimize the taxes paid on the conversion and set yourself up for more tax-efficient withdrawals later. An alternate strategy might be to spread the conversion over several years, converting smaller amounts of your tax-deferred accounts early, before the age of 59 and a half, and annually so you avoid pushing yourself into a higher tax bracket. This approach is sometimes called a Roth IRA conversion ladder. At the end of the day, we want to look at the battle between traditional and Roth IRA through the right lens. What's the tax benefit to you? You're better able to determine that answer if you understand their differences. You're not afraid because you have knowledge and are aware of the pros and cons of each investment vehicle and how they relate to your personal tax situation. You're also empowered by the strength of your own opinion, and you're not just following the crowd. You are aware and able to utilize and maximize the tax benefits of both strategies, applying them in ways that make sense for your specific situation. Remember, keep it simple. There are only 4 rules in choosing an IRA. Rule 1, if your taxes will likely drop, pick the traditional. Rule 2, if your taxes will likely rise, pick the Roth. Rule 3, if your taxes probably won't change much in the future, or you just lean more towards one strategy or the other, pick what feels right to you. And Rule 4, use a combination to allow for strategic choices later. You can reap the benefits of both. And remember, there are no wrong choices, just bad processes. I hope you'll consider these insights when you choose what investment vehicles are best for your situation. I'm Keith Demetriades. Thanks for joining me today. If you found this information helpful, share it with others. And don't forget to subscribe to the channel and hit the notification bell so you never miss an update. If you'd like to share your thoughts, you can message me. Remember, be a savvy steward, make your life count.